Mesmo depois de eu me deparar com os números e estatísticas que mostram o valor da gestão passiva indexada em relação à gestão ativa, eu fico meio assim, será que eu sou o único a enxergar isso? Será que faz sentido essa minha nova visão nos investimentos? Pergunto isso porque nas conversas de bar é um falando que ganhou dinheiro com o Google, outro que ganhou dinheiro com a Nvidia, o vizinho dizendo que comprou o carro só com a valorização do Bitcoin que ele comprou. Entro no YouTube e me deparo vídeos como qual que é a melhor ação, a nova ação do youtuber XPTO, top fundos imobiliários do momento e propagandas como essa daqui.
Para você vai ser ganhar ou ganhar. Não importa quanto que entra na sua conta corrente por mês. Eu vou te dar o dobro de dinheiro todo mês limpo.
Fala, professor. Em 2 anos e pouco tá batendo 180 mil reais. E olha que ele investiu 100 mil iniciais. Eu vou ler outro aluno aqui. Na boa, você deveria pedir desculpa pelo excesso de rentabilidade. O fundo que você recomendou já rendeu 200% do CDI. Pessoal, tá aí a prova. Se eu ficar lendo cada print, vai ser um vídeo de horas. Eu só quero dizer para você, permite se livrar de perder tempo estudando o mercado, analisando o balanço, se preocupando com as ações todos os dias, atrapalhando o seu sono. Você vai ter muito mais patrimônio, renda e liberdade. E aproveite porque são 3 anos por apenas R$ 994.
Enquanto meu lado racional me leva para ir para a gestão passiva indexada, todo o ambiente que eu estou meio que fala para fazer o contrário. É claro que é muito mais fácil cair no discurso tentador da gestão ativa. Retornos altos, acima da média, quem não quer, né? Quem não quer saber a dica de ouro, a fórmula mágica? Todo mundo, óbvio, e é claro que vão ter pessoas que enxergam oportunidade para ganhar dinheiro com isso. Seja fazendo vídeos no YouTube, vendendo curso XYZ, relatórios, mentorias, etc. Mais uma dica que eu deixo aqui para você não cair nessa tentação é que você reveja o episódio Big Numbers e principalmente do viés de sobrevivente. Os mortos, que são a maioria, não contam suas histórias. Lembre-se disso. E aí, apesar de todo esse contexto nada favorável para ir para a gestão passiva indexada, eu encontrei alguns nomes que, apesar de não ter milhares, milhões de seguidores, o currículo e a bagagem deles não tem o que falar. Seria até uma covardia compará-los com os top influencers de finanças que temos hoje em dia. O primeiro que eu vou citar aqui é o John Bogle, a lenda e ícone da gestão passiva indexada. Ele foi fundador de uma das maiores gestoras do mundo, a Vanguard, que é referência em ETFs. O livro dele, O Investidor de Bom Senso, é um must-have para quem quer investir em gestão passiva indexada. Na minha lista é o top 1 dos livros de investimentos. Então, deixo aqui um trecho de um vídeo dele falando.
And the first one you just mentioned, you alluded to a minute ago when you said, or the rule is, remember reversion to the mean. Could you expand on that one? That seems to be one of your importance.
Well, that's an eternal rule. It's like the law of gravity. What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year, cumulatively, against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. And when, for example, growth does better than value, you want to put your money in the growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. But it's part of the entire financial business. If the market gets quite out of line, stock prices, for example, get quite out of line with intrinsic values, gets high like this and it goes back and reverts to intrinsic value of the stocks. Discounted future cash flow is what we call it. It doesn't have anything to do with stock prices. It has to do with corporate intrinsic values. So, and I should have a nice chart in there to show that kind of mean reversion. It's just truth of the business and how we deceive ourselves because we all think we're smarter than everybody else.
Sei que alguns podem falar,
mas ele tem um conflito de interesse. A gestora dele cria esses fundos passivos indexados. Tem um baita conflito aí.
ok, quer levar para esse lado, beleza. Vamos pegar outros nomes então. Eugene Fama, Nobel Prize.
Before we get into the efficient market hypothesis itself, I'd like to just ask you a question, which is probably something you've been asked way too many times in your lifetime over your career, which is that when a fund manager, an active fund manager, does beat the market, you know, first of all, how is it that he's done that? Because I do know that you said in another interview that when an active fund manager beats the market, usually it's at the expense of an active fund manager that is not beating the market. That's just arithmetic. Is it possible to do this consistently? And if so, what does that fund manager have that other fund managers do not?
Well, the fund manager has insights about what determines prices better than other people's insights. But you know, the problem is identifying such people. So you can't identify them after the fact. If you go look at people who have done well in the market, you're probably just looking at somebody who was lucky. You kind of have to follow them forward and see whether they continue to do well, and then judge whether they actually have skill. So most of the performance that people measure is actually due to luck, good and bad luck.
Going into your theory now, the efficient market hypothesis states that markets perfectly reflect all information. At any given time, there's three forms: weak, semi-strong, and strong. We'll get into the details in just a bit. But Professor Fama, if a fund manager were to have beaten the market, let's say he were to have done that over the course of a certain period consistently, and he tells you, Dr. Fama, I've done that because I've made assumptions about the future that have been consistently correct. It just turns out to be correct. I'm not lucky. I'm just a good forecaster. How would you respond to him?
I'll follow you forward and see if you continue to do it, because that's an after the fact. So if I look after the fact, there will always be winners. There will always be losers, but most of that is just due to chance. So you have to follow them forward and see which ones continue to do it. And even out of that group, some will continue by chance. So you have to. This is a statistical thing that Ken French and I worked on. How do you determine the difference between luck and skill? And we did this for the whole mutual fund industry. And what you see is just a huge range of outcomes by funds over their lifetimes. But it looks a lot like what you'd expect by chance if they were all just had good or bad luck over that time period. There's a little bit of evidence that there is, in the extreme tail, there are some people that do have skill, but it's very, let me be clear. There's some evidence that's true before fees and expenses. In other words, that they can pick stocks. After fees and expenses, very difficult to find anybody that can beat the market. There probably are some. The problem is distinguishing between luck and skill. I don't think that's possible for the typical investor.
Well, let's just touch on that real quickly. You said you've done research on this. What evidence would you have to look at to determine that somebody is skillful rather than just lucky?
You can't do it for individuals. So what we did was to take the whole population of mutual fund managers and say, what would the outcomes for this whole population look like? In other words, all of them. What would they look like if they were just lucky? What kind of distribution of results would you see if everything was due to chance? And it looks very much like the actual distribution. And there's just a little evidence that if you give them back all their fees and expenses, the right tail, in other words, the good tail of the distribution, looks a little thicker than you'd expect by chance. But after fees and expenses, that disappears. So basically, there's not much evidence that investors get better returns from active management.
Certainly, there's the entire passive management industry, one could argue, was spawned due to your research, because I guess people have resigned to the fact that it is not easy or even possible to consistently actively beat the markets over time, and so why not just design an index, or an index fund rather, that just tracks the benchmark. I guess that leads to my ultimate question before we talk about your theory is it possible to consistently beat the markets without it being resigned to luck over an extended period of time, perhaps over a multi-decade career?
Sure, it's possible. Anything's possible. But the problem is identifying that person and distinguishing luck from skill. That I defy anybody to do. After the fact, it's impossible.
Agora vamos para um outro Nobel Prize, que é o William Sharpe.
Less through traditional, actively managed mutual funds. What's the difference between the two strategies, and why is index funding a better approach for investment?
Well, that story came out of things like the capital asset pricing model. Not very complicated little mathematical models, but mathematical models nonetheless. But as is so often the case, you can find that you can get the same conclusion much more simply. And so let me just share with you. A number of years ago, I published a little op-ed type piece in the magazine of the Financial Analysts Federation. So basically 150,000 practicing investment people read this because it's their professional magazine. It was called The Arithmetic of Active Management, and it was embarrassingly simple, and the argument is it's very simple. Let me just play it with you, if I may, if you'll indulge me. Imagine that everybody in this room collectively hold all the securities in, let's say, China, since we have somebody from China. It's not a very well-developed market. That's okay, it'll work. And we're going to divide you into a third over here. You're going to be index fund managers. Got Jim in the right place. And over here, the 2/3 of you, you're going to be what we call active managers. I'll tell you what you do. What you do is really simple. You just find out how many shares are outstanding of every security in China. And if you've got 1% of the money, you buy 1% of every single company on the Chinese market. And you all do the same thing. You do research, you learn about companies, you study industries, you visit plants, Lord knows what you do, but you find the companies that are really cheap and you disdain the companies that are really expensive by your lights. You do the same, you have different research, you have MBAs from Stanford, you have MBAs from Harvard, blah, 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 blah. So you do your things. And we call you active because periodically you change your mind and you sell things and buy things so the brokers like you and you get good seats at football games, okay? Okay, so you guys are active managers, you guys are passive managers. A year passes. The total Chinese stock market returns 10%. Before costs, what does Jim get? Quick. 10%. 10, okay. What do you get? 20. What do you get? -5. Over there is somebody who actually short stocks, whatever that is, and lost 80%, what have you. So you guys are all over the map. Question, before costs, what is the return on the average yuan or renminbi in this side of the room? What is the average return before costs on the average yuan or renminbi in this side of the room? You got it. After costs, these guys are cheap. They don't know anything. They don't do much. These people are expensive. They've got degrees from prestigious business schools. They do all this research. And the difference is something like, well, Schwab just announced they've cut their index fund fees on a couple of index funds to 9 cents per year per $100. The average manager over here is going to charge $1 per year per $100. So after costs, the average yuan or renminbi over here must underperform over here. And here's the irony, if you sort of think that through and say, well, maybe I'll get the one who's so smart over here that they can overcome their costs and beat the market. But then again, maybe I'll get him. So let's all go over here. But then the whole system breaks down because we need these people to be doing their research and keeping the prices reasonably in line with prospects. So it's a kind of a public good problem in which these people provide a great service to keep markets reasonably well functioning so these people can ride for free. It's a free rider problem. And I've worried over the years that if I say this to too many people, some of these guys will move over here, but they never do. They never do.
Why don't they?
I mean, you read, look at all these. How many of you have seen, stock picking magazines? I don't care if it's Forbes, Fortune's doing it now, Business Week. Here's a hot manager. Here's a hot strategy. Here's what's going to win next year. Bull. Bull. If markets would have to be crazy to make it possible for somebody to write an article in a magazine, let alone somebody to read an article that others have already read, and ex ante do better. Ex post, some of these people are going to beat these people, but ex ante, you're better off over here. But don't tell too many people.
Agora vamos para alguém mais famosinho que está mais na mídia, que é o Morgan Housel, que escreveu a Psicologia Financeira. Esse livro é um dos mais indicados pelos influencers de finanças, inclusive por aqueles que indicam as melhores ações para comprar, vendem relatórios dos melhores fundos de investimentos que existem no mercado, só que tem uma parte na página 272 que eles não contam. Acredito que para a maioria dos investidores, a média de dispêndio em dólar de um fundo de índice de baixo custo oferece as maiores chances de sucesso a longo prazo. E na página seguinte, 273, ele comenta: e é isso, na prática, todo o nosso patrimônio líquido se resume a uma casa, uma conta corrente e alguns investimentos no fundo de índice Vanguard. Essa é a mesma Vanguard que foi fundada pelo John Bogle que eu citei anteriormente. Bom, e para fechar com chave de ouro, nada melhor do que citar o Papa para muita gente que acredita no stock picking, dessa gestão ativa e tudo mais. O famoso Warren Buffett. Sim, olha o que ele fala.
I really thought that maybe we were giving a little bit the wrong lesson. Because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
Lembra do John Bogle que iniciou a gestão passiva no mundo? Olha o reconhecimento que o Buffett fez para essa pessoa lá em 2017.
One more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. There's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it. Ben Graham even talked about it. But the truth is, it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him. And he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds. And we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors.
Bom, não preciso dizer mais nada, né? E você sabe o que o Warren Buffett recomendou para os seus herdeiros quando ele bateu as botas? Foi o seguinte: meu conselho ao administrador não poderia ser mais simples. Coloque 10% do dinheiro em títulos governamentais de curto prazo e 90% em um fundo de índice S&P 500 de custo muito baixo. Sugiro da Vanguard do John Bogle. Eu acredito que os resultados de longo prazo dessa política serão superiores aos alcançados pela maioria dos investidores, sejam fundos de pensões, instituições ou indivíduos que empregam gestores com taxas elevadas. Bom, depois dessa, finalizo por aqui. Acredito que já temos bons nomes de referência por trás dessa filosofia de investimentos mais minimalista focado na gestão passiva indexada. Pelo menos para mim, quando eu descobri esses nomes e essas opiniões, me deixou muito mais tranquilo para eu fazer essa migração nos meus investimentos. Migração que inclusive apresentarei no próximo episódio.